Hi, thanks so much for tuning in. You're watching BQ Prime, and this is the Mutual Fund Show, the show that gets you all the information that you need to make the right investment choice. This week, we're talking about multi-asset allocation funds. What are they? What purpose do they serve in your portfolio? And how should you invest in them? Joining me to tell you all of those things and more are two very special guests. We've got Kirtan Shah, who's the founder and chief executive officer of Credence Wealth Advisors, and Vishal Dhawan, who is the founder and chief executive officer of Plan Ahead Wealth Advisors. Thank you so much, gentlemen, for taking the time. I will ask the most basic question first, and I'll come to you, Vishal, on this one. What is a multi-asset allocation fund, and what are the key characteristics?
Thanks for having me over. So essentially what a multi-asset fund does is it tries to pick different asset classes and puts it together in a package so that it becomes much easier for investors when they're trying to make decisions on which asset class to invest in. And of course, this package is mostly managed actively by a fund manager to decide on, for example, within equities, which stock should I buy? Should they be large cap, mid cap, small cap? Should they be, value or growth style? So all of those pieces are typically also decisions that get made. And what the manager does typically is rebalances this portfolio between equity, debt, and gold in a manner where, depending on the view that the manager may have on a particular asset class, that decision also gets taken by the manager himself or herself. So it's a good package deal for investors to look at. And of course, there are some funds which also may look at adding in international investments. They could look at adding in products or things like REITs, InvITs, etc. So I think as an overall package, it's a sort of a ready-made asset allocation solution, though not exactly that.
Okay. I'm going to take that last comment and go to you, Kirtan, because often we speak about asset allocation and the fact that it has to be done in association with the financial goals that you've made. And each investment that you make has to be within a larger framework. It has to be a patchwork quilt, if you can call it that. Does a multi-asset fund, because it kind of does that, does it replace the need for asset allocation?
Alex, no, it does not. I think it's not just the multi-asset fund, but you pick up any hybrid fund as a category. I don't think that replaces your asset allocation requirement. Because look, what happens is asset allocation requirement is very individualistic. Depending on what your risk profile is, what your goals are, how much time do you really have to reach those goals. The asset allocation is very customized with respect to what your requirement is. At the fund level, you can't have one customization done, right, which is going to be equivalent to everybody who's invested in the fund. So the fund's asset allocation cannot always be correct for individuals who've invested in the fund. And also what happens is at the fund level, the asset allocation is pretty tactical in nature, right? Like Vishal also mentioned, that it is the fund manager's prerogative, depending on the objective of the fund, of which asset class does it want to focus more on, right? If the fund manager feels that the equity valuation is down, they might increase equity valuation, right? But that does not or may not suit everybody who's invested in the fund in terms of asset allocation. So at the fund level, the asset allocation is pretty fluid, tactical in nature, whereas when you look at an individual's asset allocation, which is largely going to be constant. So at the fund level, you can't really have asset allocation that will match everybody who's invested in the portfolio. So no.
Okay, fair point. Having said that, let's look at the positive characteristics of this as well. I will go to you on this one, Vishal. According to you, what are the benefits that are involved in investing in something like this?
So at least a few of them are very, very clear. One is the behavioral aspects around investing tend to be a very, very important part of how end outcomes end up being for investors. And what we've historically seen is that when equity markets go up, money flows into equity. And at points that might be the wrong time for that to happen because markets may be very expensive at that same point. So when you have a multi-asset allocation fund, you end up having exposure to multiple asset classes. The last 1 year is a very good example. So if you went back to a year ago, I don't think a lot of people believed that gold is going to be the best performing asset class over the next 12 months. And therefore, a lot of people were cutting down gold exposures and actually adding equity. Whereas if you look at it today, you would find that gold actually outperformed equity. And therefore, it's very, very interesting that by having a multi-asset allocation fund, which is managed on the basis of, some sort of a model that a fund manager decides, you could actually be buying, low and selling high, which is actually what you want to do as an investor. The second benefit of a multi-asset fund is that you don't need to be tracking every asset class at every stage because you're busy as an investor in your own profession and doing other things. And maybe you're not even skilled enough to be able to make those choices. And what the fund manager does is therefore takes on that role for which you are paying him or her a fee. The third advantage, which has probably just about happened in the last couple of months, has been the change in tax treatment on standalone debt and gold relative to structures where there are combinations where equity is at a higher level. And what has now happened is that there is some tax arbitrage as well available to investors buying multi-asset funds, where the tax treatment of the entire structure is of equity, even though the underlying may include some debt and some gold as well.
So let me get this straight. If the assets under management, more than 50% is equity, then it gets treated as an equity scheme, right? Is that the threshold?
65%.
65%. Okay. So but then in that case, if the asset allocation, because of the nature of this scheme, falls below 65%, then how does it get taxed?
So what it would get taxed actually as debt in that particular case, which means long-term capital gain benefits would not be there. But what one would expect managers to do in those situations is use strategies like arbitrage.
Sure.
To still get the equity tax treatment going for the fund.
Understood. Okay. So Kirtan, coming to you, you've said that it does not replace the need for asset allocation, and therefore you would need to necessarily have a combination of equity and fixed income schemes in your portfolio, or in fact, the underlying, you can buy equity as well. But does this have a role in your portfolio? Would you say that it still makes sense for an individual to have some sort of allocation towards a multi-asset allocation fund?
Alex, I think this is very individualistic. I think the biggest problem here, while as retail investors, everybody is trying to understand what purpose is multi-asset fund solving, I think they'll have to understand that the industry is pretty divided. So if you look at the 12, 15 funds that are available today, or probably the new funds that are going to come in, first thing that the retail investor will have to do is to understand how is one fund different from the other. Because I presume that there are multiple funds in this category today and in the future that are going to come up, which will have completely varying strategies from each other. Now, one fund may use arbitrage so that they can have those 65% in equity allocation, so that they can get taxation in a certain sense. Whereas there is this another fund which completely does justice to what a multi-asset fund should ideally do. So I think first point, before you decide whether this falls into your choices of funds and investment, is to be able to figure out that in the industry, when you have so many of these funds available, which one suits your need the most. Because you cannot place all multi-asset funds together and say they are all apple to apple. They will not be probably 6 months from today.
Yes.
So one. Second also is to understand that largely in theoretical concept, you will look at a multi-asset fund in the context of a fund which, when compared to an equity fund, let's say for example, will not have as much as volatility as equity, but will not generate returns as much as equity would, right? So I would place it somewhere in context saying that multi-asset fund is a fund probably which might be able to generate for you debt plus some returns with probably debt kind of risk. I think that is what you all as investors should keep in mind before you end up choosing whether multi-asset fund will really play a role in the portfolio or not. But like I said, the strategies are very different from fund house to fund house. So picking the right multi-asset fund will also play a very important.
Do you have any schemes that you've studied closely, Kirtan, that you would like to talk about?
Alex, actually not. I'll tell you why. Is because these multi-asset funds have hardly been around, right?
Yeah.
Most of the multi-asset funds that we see are funds who predominantly been some other category, but after the categorization rule changed, their category was changed and made into multi-assets. Yeah. And most of these others are 1 year, 2 year old schemes in this space. So I think we'll have to give it some time for us to be really able to understand the actual performance or the strategy of these fund houses vis-a-vis the execution on the ground. So I don't have a fund that I really want to name, but if I really have to pick one, I will definitely look at the strategy because I think these strategies are very different from each fund house to fund house.
Fair point. And speaking of strategy, in fact, the second part of this conversation is meant to understand just that. But it brings us to the end of this first leg. Thank you so much, Vishal, as well as Kirtan, for taking the time and for helping us understand this category of mutual fund schemes a little bit more. Now, viewers, do stay tuned because the second leg of this conversation is going to do just what Kirtan was suggesting, which is to understand how a fund manager thinks about managing the scheme. And to that end, it gives me a great deal of pleasure to introduce you to Dinesh Balachandran, who is a fund manager at SBI Mutual Fund. He manages quite a few schemes, but one of those is the SBI Multi-Asset Fund. Thanks so much, Dinesh, for taking the time. And at this point, we've more or less established what this scheme, the multi-asset allocation scheme, is meant to do. But let's talk about how you manage the scheme. Obviously, you have to have the regulatorily mandated 10% per asset and those 3 minimum assets. But how do you decide how much goes into each asset?
Great. First of all, thanks a lot, Alex, for having me over. Just to explain the SBI Multi-Asset Allocation Fund in more detail. So this fund is expected to have 3 asset classes: equity, fixed income, and gold. And as you rightly mentioned, in each of these asset classes, we need to have a minimum 10% allocation. That is as per the regulatory mandate. Now, in terms of how we actually manage it, this is based on an internal model that we've developed, where when you think about the model in very simplistic terms, what it is trying to do is it is essentially looking at the risk profile of these asset classes. Now, what do we mean by risk profile? This is measured more in terms of volatility or the fluctuations in prices for each of these asset classes. And the thought process is that an asset class that is showing more volatility, more fluctuations, you would want to have lower allocation to that asset class, while a different asset class that is better well behaved, where you don't see like too much turmoil or too much volatility, you want to have higher allocation to that particular asset class. In theory terms, this is called as a risk parity model, but the thought process is very simple, that you want to allocate more to asset classes that are better behaved, and you want to allocate less to asset classes that are showing more volatility.
So would it be fair then to say that the objective of the fund is not capital appreciation? It is, to a certain extent, primarily capital protection and incidentally capital appreciation.
It's funny, as Charlie Munger used to say, the number one rule in investing is to not lose money. Often by not losing money, you end up essentially making enough returns. So as long as you're able to take care of the downside, the upside is automatically going to come. Okay. So while this might not be the highest return generating fund over a longer period, because we are a lot more mindful of the downside risk, in my opinion, can this generate sufficient returns that should keep most investors happy? I think the answer is yes.
Okay. So let's delve a little deeper into how this strategy course of the management of this scheme. There would have been instances where has been elevated volatility in any one of these asset classes. Could you give me illustrations of how the asset allocation has moved? Because you have significant room to change things around.
Yeah. So we we have leeway to go all the way from 10% to 80% in each of these asset classes. So we have sufficient room. Now, in terms of how we've actually ended up using it, think about what fixed income did over the last year and a half, if you exclude this year. The volatility in fixed income post-COVID started moving up significantly, where interest rates around the world started going up and people probably not prepared for it. So automatically you started seeing the volatility, which is basically the fluctuation in prices of fixed income go up. And so from a model framework perspective, it made sense for the model then to have lower allocation to fixed income and have higher allocation to equities, because equities after the COVID crash and then subsequent recovery was actually much better behaved. So the thought process is that at any given point in time, you try to sort of figure out which asset class is relatively well behaved, where the chances of a meaningful downside risk is lower, and you allocate more to that asset class.
Okay.
And the reason why we chose this particular framework is when you think about equities, you can think about it in terms of earnings, cash flow. When you think about fixed income, you can think about interest rates. These are very intuitive things for most people. But when you think about gold is not a cash flow generating asset.
Yes.
So how do you then think about gold? And when you want an asset allocation that involves equity, fixed income, and gold, you can't speak in terms of cash flows. You have to think about other ways to decide on asset allocation. And that is how we ended up with this risk parity paradigm.
Okay. So then from that perspective, you mentioned, barring the last, say, 2 months, where you've seen a very sharp change in the yields. At this juncture, we're poised at a moment where perhaps the Fed is done hiking. Perhaps. Again, we can't say for certain, but I guess there's more certainty here in India with regard to what the RBI is doing and the Monetary Policy Committee is doing. So where we stand right now, how do you adjust your strategy? Would you load up on fixed income at this juncture, considering that the move downwards could benefit quite significantly with regard to capital appreciation?
Yeah. So again, when we look at the fixed income landscape, sometime towards the end of last year, we could again see a change in paradigm, where essentially signals started coming out that maybe we've seen a peak in interest rates. The volatility in fixed income markets also started coming down. And that allowed us to actually increase our allocation to fixed income securities. So that has actually worked out well over the last 6 months or so. Now, when I think about what is going on in the fixed income space, there are two schools of thought. And honestly, it is not clear which camp is going to come out ahead. There is one school of thought that essentially says that interest rates have peaked and growth has started slowing down, which means that at some point you're going to have interest rate cuts. If that is the case, then fixed income markets, even at current levels, after having done quite well over the last 6 months, they look very attractive. The other camp essentially says that, okay, rates have gone up enough, and maybe RBI and other central bankers are probably going to pause for the time being. But do not mistake the pause for interest rate cuts, which means that you can essentially be in a higher for longer sort of camp, right? You can be in that kind of space. In that scenario, yields are more likely to be range bound, and further upside from current levels is less likely. At this point, honestly, the jury is still out there. We also don't have very firm opinions because a lot of it is based on macro factors that are evolving. At this point, all I can say is the majority of the yield move is probably done. And at the margin, we are more looking for higher accrual or higher carry in the fixed.
Understood. Okay. So I had actually asked you in the previous question to give us an illustration of how your allocations have shifted. And if I am not mistaken, Dinesh, as things stand right now, you have about 50% of AUM in equity, and you have about 10% in gold. If I'm not mistaken, you have again about 20% in fixed income, right? And you have about 15% in cash. Now, I'm spitballing here because I remember having read this in the snapshot that I saw. Why are you holding cash?
Yeah. The holding in cash was more of a temporary affair because we were waiting for certain securities to be issued. So we were very interested in this road InvIT that was going to be launched, and we wanted to have some cash set aside for that. And we also were very interested in buying two specific fixed income securities that were going to be launched soon. So the high cash level was more a byproduct of waiting for these securities to be issued so that we can deploy that money. Post that, the cash levels have come down significantly. And so it's no longer at that 15% level that we probably saw in the last fact sheet.
Understood. Okay. But then to the earlier question, has there been a dramatic shift in the allocation, or has it more or less stayed the same? Just to elucidate the point that you've been making about the ease with which you can move around your assets.
Yeah. So the asset allocation has moved meaningfully over the last couple of years. When I look at the equity component would have, broadly speaking, moved in a range between 25% to 55%, while the fixed income component would have moved between 30% to 60%. And in fixed income, I'm also including cash. So the range has been roughly 25% to 30% over the last 2 years, which again speaks to the fact that asset allocation in this framework is going to be dynamic in nature. Depending on how the situation evolves, we are going to sort of move the asset allocation in a non-trivial manner.
Understood. Now, you've already spoken about fixed income. We are yet to speak about equity as well as gold. I'll ask about gold first. Now, a lot of people have spoken about where gold prices are right now. We're near the peak, or rather, we're near all-time highs, and some people are saying that we're near the peak. What is your own strategy? When it comes to asset allocation for an individual, often I have heard advisors say that you should not have more than 10% allocation towards gold. Is that something that you pay attention to at all, or is it another factor that you look at? What does the risk parity approach say about gold allocation?
Yeah. So we are not in the camp that gold prices have peaked. When you think about the factors that normally drive gold, two major factors are real interest rates and systemic stability. Particularly when I think about systemic stability, I have this concern that there are a lot of systemic risks, not in India, but in developed markets, where these risks are probably being underpriced by market participants. We just saw this episode of the bank run crisis, where depositors were sort of removing money from a lot of the smaller regional banks in US. That story hasn't fully played out, in my opinion. We are now also entering this debt ceiling debate, where it's anyone's guess in terms of how this is truly going to evolve. So broadly speaking, when I think about the developed market, there are several risks that are rather systemic in nature. And from that perspective, having that gold as part of the asset allocation mix, in my opinion, is a very effective hedge against these kind of systemic events. Not to mention, when I think about real interest rates, as growth slows down, there is a possibility, again, we'll have to see how it exactly evolves, but there is a possibility that central bankers might start becoming more dovish, which is essentially saying that real interest rates can potentially start going down. If that happens to be the case, then gold can do very well in that scenario as well. So overall, has gold done well? Yes. Should gold not at all be part of the asset allocation mix at this point? I beg to differ. I think that there are good reasons to have gold also as part of the asset allocation mix.
Fair point. Now, coming to the close of this conversation, just to understand the rest of the assets, you have equity and you have allocation towards InvIT. You have allocation towards real estate companies, but no REITs from what I saw. Could you help me understand this leg of it, the rest of the allocations to the other assets that are available?
Yeah. So in general, we are actually in favor of cash flow yielding assets, where if we are getting attractive yields, it's something that we would definitely like to invest. As I mentioned earlier, we have invested in an InvIT security. The reason why we haven't invested in REITs is that, in our opinion, the pricing of these assets was very aggressive to begin with. And there was nothing left on the table. So it's not as if the asset class has any problems. It was more the pricing of these assets that was the problem. As and when pricing becomes more attractive, we will definitely be interested in looking at these securities.
Okay, Dinesh, just to sum things up, on the equity side of things, how do you construct the portfolio? And just to give us a quick understanding of this, is this different from how you would manage a pure equity portfolio?
Yeah, so the equity portion here is going to be managed like how we would manage a pure equity fund. But what I'll say here is this. In this case, we've decided that we'll be market cap agnostic, which means that we are not going to sort of force ourselves to be large cap only, mid cap only, or small cap only. We are going to go where the opportunities are. So at this point, for example, the fund has a higher allocation to small cap stocks, mainly because we see a lot more opportunities in the small cap space. As and when that changes, and if we feel that risk reward is much better in the large cap space, we wouldn't mind being a 100% large cap stock equity portfolio. So it really is a function of where the market opportunity.
Yeah, and flexibility seems to be the key here. Dinesh, absolute pleasure speaking to you on the Mutual Fund Show. Thanks so much for taking the time.
Yeah, thanks a lot, Alex. Thanks again for having me.
Viewers, thanks so much for tuning in to the Mutual Fund Show. Let us know what you think in the comment section and stay tuned. This is BQ Prime.